Investing in the stock market is one of the most intimidating aspects of financial wellness. You need to get your head around all the confusing jargon. You can expect fluctuations in the market. Additionally, investing comes with a certain degree of risk. Perhaps you're putting off investing because you're not confident about how the stock market works. Let's make investing in the stock market less overwhelming, shall we? Hello and welcome back to the Finance Guardian channel. In today's video, we'll delve into things such as stocks and how the stock market works. Hit that subscribe button and the bell beside it and let's get started. What is a stock? We must first have a basic understanding of how stocks work before we can begin to talk about stock markets. Stock is regarded as a financial instrument that represents ownership in a company and results in a proportionate claim on its earnings and assets. Stocks are also referred to as shares or a company's equity. A share of stock represents ownership in the company. For example, when you buy shares of Apple, you own a small part of the company and gain access to its profits. To put it simply, instead of being owned by an individual or group of individuals, some companies choose to go "go public," which means that anyone can become a part owner by purchasing shares of the company's stock. What is a stock market? In general, a stock market is a collection of exchanges and other venues where shares of publicly held companies can be bought, sold, and issued. These financial activities are typically conducted via institutionalized formal exchanges, physical or electronic, or through over-the-counter markets that are governed by a strict set of rules. The stock market provides numerous opportunities for buyers and sellers of securities to meet, to interact, and transact. The stock market allows for the discovery of the price of shares of corporations and also serves as a barometer for the overall economy. Since there are many participants in the stock market, one can often be assured of a fair price and a high level of liquidity as various market participants compete for the most favorable price. The stock market is a regulated and controlled environment. The Securities and Exchange Commission and the Financial Industry Regulatory Authority are the main regulators in the United States. Due to the fact that the stock market brings together hundreds of thousands of investors, it ensures that prices are fair and transactions are transparent. In contrast to earlier paper-based physical share certificates, modern computerized stock markets operate electronically nowadays. Is there a difference between a stock exchange and a stock market? Although the terms are interchangeable, a stock market isn't the same thing as a stock exchange. The stock exchange is a component of a larger whole. The stock market consists of multiple stock exchanges, such as the Nasdaq or the New York Stock Exchange in the United States. Whenever people discuss stock market performance, they are referring to the thousands of companies listed on multiple stock exchanges. As a whole, the stock market includes bonds, mutual funds, exchange-traded funds or ETFs, and many other types of securities that are beyond stocks. How does the stock market work? It is possible to learn the basics of the stock market without getting bogged down in the details. Essentially, stock markets provide a safe, regulated environment where market participants can make transactions in shares and other permissible financial instruments with little or no operational risk. The stock markets can also act as primary and secondary markets according to the rules defined by the regulator. In an initial public offering or IPO, companies are able to sell their shares for the first time to the general public via the stock market as a primary market. Through this activity, firms are able to raise necessary capital from investors. This basically means that a company sells part of its shares to the public at a specific price. It's necessary for these shares to be sold on a marketplace for a company to facilitate this process. The stock market is the one that provides this marketplace. In return, investors will receive the company's shares, which they can anticipate holding for their preferred length of time in anticipation of a rising share price and any potential dividend income. During this process, the stock exchange acts as a facilitator and receives a fee from the company and its financial partners. What factors influence the price of shares? On a stock market, shares can be priced in several different ways. Typically, buyers and sellers place bids and offers to buy or sell through an auction process. An offer is the price at which a seller wishes to sell, and a bid is the price at which someone wishes to buy. When the bid and the offer line up, a trade is made. Many investors and traders make up the overall market, and they may have differing opinions about a specific stock's value and thus different price points for buying or selling it. Thousands of transactions occur every day as investors and traders buy and/or sell stocks as their intentions become actions. These transactions cause the price of a stock to fluctuate minute by minute. Buying and selling stocks can be done more easily through the use of a stock exchange. A stockbroker would be required for the average person to access these exchanges. In this case, the stockbroker acts as the middleman between the seller and the buyer. The most common way to get a stockbroker is to open an account with an established retail broker. Supply and demand in the stock market. Stock market activity is a fascinating example of supply and demand laws in action in real time. In order for a stock transaction to take place, there must be a buyer and a seller. As a result of the immutable law of supply and demand, if there are more buyers and sellers of a stock, the stock price will increase. In the opposite situation, the price of the stock will decline if there are more sellers than buyers. The difference between a stock's bid price and its ask or offer price is called the bid-ask or bid-offer spread. This represents the difference between the highest price at which a buyer is willing to pay or bid on a stock and the lowest price at which a seller is willing to sell it. When a buyer accepts a seller's offer or a seller accepts a buyer's bid, a trade transaction occurs. When there are more buyers than sellers, bids may rise in order to acquire the stock. The price will therefore increase as sellers demand higher prices. If the number of sellers outnumbers the number of buyers, the seller will accept a lower offer for the stock, while the buyer will lower their bid, effectively lowering the price. Matching buyers and sellers. It's sometimes necessary for professional traders to maintain constant bids and offers in some stock markets. This is because a buyer or seller may not be present at any given moment. They are known as market makers or specialists. A major reason for using the market maker system instead of simply allowing investors to deal with each other directly is to ensure that there is always a buyer available to match every seller and the other way around. When you want to sell a stock, you don't have to wait until a buyer wants your exact number of shares. The market maker will purchase them right away. A two-sided market consists of a bid and an offer, and the spread is the difference between the bid and the offer. Liquidity of the stock increases with a narrower price spread and more bids and offers. Moreover, if there are many buyers and sellers at sequentially higher and lower prices, this implies that the market has substantial depth. In the past, matching buyers and sellers of stocks on a stock exchange was done manually, but these days it is increasingly done by computerized trading systems. During the manual trading era, traders utilized a system known as open outcry. In this system, they communicated verbally and by hand signals to buy and sell large blocks of stocks in the trading pits or the exchange floors. Nevertheless, most exchanges now use electronic trading systems instead of the open outcry system. By using these systems, buyers and sellers can be matched much more quickly and efficiently than humans can. This can result in significant benefits such as lower trade costs and faster executions of trades. How important are stock markets? One of the most important aspects of a free market economy is the stock market. It facilitates the raising of capital for businesses by selling corporate bonds and stock shares. It is possible for common investors to profit from a company's financial success, earn dividends, and make profit from capital gains, but they may also lose money. Although institutional investors and professional money managers do enjoy some privileges because of their deep pockets, market expertise, and higher risk-taking abilities, the stock market aims to provide a level playing field to regular individuals. A stock market functions as a channel for individuals to efficiently allocate their savings and investments into profitable investments. In the long term, this helps boost the country's economic growth and capital formation. And that is all the time that we have today, folks. We hope you enjoyed this video, and if you did, please remember to hit that like button. If you're new around here, welcome and subscribe to our channel, and on your way out, please do remember to click on that bell icon too so you can remain updated about all of our future videos. You're welcome to the channel where you will learn the basics of personal finance in easy to understand language. We'll see you next time.